Before you decide that a stock is cheap or expensive, ask yourself one absolutely crucial question. Are you comparing it with the right companies? You see, lazy industry labels do not equal economic similarity. If you're grouping stocks together just because they happen to share some broad sector tag and a financial screener, well, your valuation is practically compromised before you've even calculated a single multiple. So let's get clear on what relative valuation actually is. At its core, it asks a pretty straightforward question. How is the market currently pricing this company compared to other businesses that have similar economic characteristics? Instead of trying to guess intrinsic value in a vacuum using super complex discounted cash flow models, we're using observable, real-world market prices. We compare those prices against financial measures, things like earnings, revenue, EBITDA, or free cash flow. But here is the critical catch, and the main thing you need to take away from this. This entire method depends 100% on the quality of your peer group and the specific metric you pick. Bottom line, if your peers are wrong, your valuation is flat out wrong. All right. Section 1. Filtering for economic similarity.
Think of this process like a giant peer selection funnel. You start with a massive universe of stocks, but then you ruthlessly filter it down based on actual business economics. Step 1, look at the business model. Are we talking recurring revenue or transactional sales? Steps 2 and 3, filter for growth rates and profitability margins. Then step 4 is capital intensity. How much cash does this business literally need to consume just to maintain itself? Step 5, you've got to check the balance sheet leverage, because debt fundamentally changes equity risk. And finally, step 6, verify their end market exposure and cyclicality. Let me give you a perfect example of why this matters so much. Imagine a subscription software firm and a hardware manufacturer. A standard screener might toss both of them into the exact same technology bucket, but their recurring revenue, gross margins, capital intensity, their cash conversion, they are radically different. Comparing their multiples is completely meaningless. Remember, economic similarity always trumps industry labels similarity.
Moving on to Section 2, choosing the right multiple. Okay, take a look at this valuation multiples cheat sheet. It breaks down exactly when to use which metric, and more importantly, it highlights the hidden traps of each. Even the SEC warrants that desirable ratios vary wildly by industry, so we really need to pay attention here. Let's take the price to earnings, or PE ratio. It's a classic. It's best used for profitable companies that have comparable leverage and tax profiles. But the big caution here? PE is heavily distorted by interest expense, taxes, and random accounting items. If your companies have completely different capital structures, meaning entirely different levels of debt, you really need to shift over to EV/EBITDA, just like the CFA Institute recommends. EBITDA is a pre-interest measure, which makes it fantastic for comparing operating businesses with differing leverage. Just keep in mind, EV/EBITDA completely ignores capital expenditures and working capital needs. And what about EV/revenue? Well, it's great for high-growth, early-stage businesses that are currently running negative profits. But the massive warning label here is that revenue alone tells you absolutely nothing about a company's eventual profit margins or cash generation. And that brings us to the absolute golden rule of relative valuation. Are you ready? Never, ever mix an equity value numerator with an enterprise value denominator. I'm telling you, it is one of the most common beginner errors out there, and it will completely destroy your valuation model. Here's how it works. Market capitalization represents the value to the shareholders, the equity. Therefore, it has to be paired with equity measures like net income, which gives us our PE ratio, or free cash flow. Enterprise value, on the flip side, represents the total value of the firm's operations to all capital providers. That means both debt and equity. So it must be paired with operating metrics like revenue, EBITDA, or EBIT. Mixing these two up, it's literally like comparing miles per hour to gallons of fuel. It makes zero mathematical sense. Let's dive in to Section 3, the CloudCo valuation example. To put this all into perspective, we have a fictional company here called CloudCo, alongside 5 potential peers that a standard screener just spat out. CloudCo has 22% revenue growth, a 25% EBITDA margin, and modest leverage, sitting at 0.5 times net debt to EBITDA. Now, if we act like lazy analysts, we just average all 5 of these peers and call it a day. But let's actually look a bit closer at the numbers. Peer D is growing at only 11%, and it's carrying high leverage at 1.6x. Peer E, sure, it's growing fast at 28%, but it's got a weak 18% margin and a massive 45x PE ratio. They just don't share CloudCo's economics. But take a look at peers A, B, and C. Their growth sits right in that sweet spot around 20 to 24%. Their margins are incredibly tight, between 23 and 27%. Plus, their leverage profiles are highly comparable. CloudCo's economics align beautifully with peers A, B, and C.
By making those three your core peer group rather than just blindly averaging every software stock on the board, you get a much more accurate and defensible valuation.
So if we take the median from that refined peer set, peers A, B, and C, we land on an illustrative EV/EBITDA benchmark of 23x. If Cloud Code generates a normalized EBITDA of $2.0 billion, the math is pretty simple. We just multiply that $2.0 billion by our 23x multiple. That gives us a total enterprise value of $46 billion for CloudCo. But here's the thing. As stock investors, we don't actually buy enterprise value. We buy shares of equity. So the big question is, how do we get from that massive enterprise value down to a per-share stock price?
To do that, we use what's called an enterprise value to equity value bridge. We just walk right down these exact steps. Step 1, we start with that $46 billion enterprise value we just calculated. Step 2, we subtract the net debt. Why? Because the bondholders always have to be paid first. Step 3, we add back any excess cash just sitting there on the balance sheet. Step 4, we adjust for other debt-like claims. This could be unfunded pensions or maybe significant lease liabilities. That brings us to Step 5, calculating the final equity value. That's the actual slice of the pie that belongs to the shareholders. Finally, Step 6, we take that equity value and divide it by the total number of diluted shares outstanding. And boom, that gives us our implied stock price.
Hey, real quick, if you're finding this useful, subscribe to Fox of Wall Street, share this explainer with another investor, and like the explainer for more practical stock market education.
All right, back to it. Section 4, adjusting for quality and risk.
Now we need to look at the premium and discount bridge. You see, a relative valuation analysis should never, ever end with, well, the peer median is 23x, therefore the stock is worth 23x. You always have to ask why. Think about it. A company that's growing faster than its peers, producing higher returns on invested capital, or generating super predictable cash flows, it absolutely deserves to trade at a premium compared to the group median. On the flip side, if your target company suffers from weaker margins, maybe heavy customer concentration, high balance sheet leverage, or crazy cyclicality, it requires a discount. For example, a 30x PE is not automatically expensive if those underlying earnings are growing rapidly and sustainably, and a 15x PE isn't automatically cheap if the business is structurally in decline. The multiple is really just a thermometer. You still have to diagnose the patient.
Now, because this entire process takes a lot of judgment, beginners often stumble into a few common traps. Let's quickly run through the biggest valuation mistakes so you can avoid them. Number 1, choosing peers just because they share a ticker sector classification. Lazy, right? Number 2, trying to use a PE ratio for companies that have negative or heavily distorted earnings. Number 3, mixing a trailing 12-month multiple for one company with a forward-looking multiple for another. You've got to keep your timeframes consistent. Number 4, completely ignoring real economic costs like stock-based compensation or lease liabilities. And lastly, number 5, relying purely on third-party financial websites without actually opening up the latest 10K and 10Q SEC disclosures. Always remember the actual SEC filings are your primary source of truth.
Let's wrap it up with Section 5, the 8-step valuation checklist.
Okay, here is your highly repeatable 8-step valuation checklist. Step 1, clearly define the target's business model and its key economic drivers. Step 2, build an initial list of 8 to 15 potential peers. Step 3, ruthlessly remove any companies with materially different economics. Step 4, normalize the data for any one-time items. Step 5, select 1 or 2 primary multiples, plus 1 cross-check metric just to be safe. Step 6, use medians and ranges. Never rely on a single blind data point. Step 7, explicitly explain why your target actually deserves a premium or a discount. And finally, Step 8, stress test your valuation under a few different growth and margin scenarios. The ultimate lesson I want you to take away from all this is that the hardest part of relative valuation, it isn't the math is easy. The truly hard part is doing the work to choose the companies that actually deserve to be compared. Before we go, please remember, this explainer is for educational and informational purposes only and is not investment, financial, tax, or legal advice. Examples and illustrative figures are not recommendations to buy or sell any security. Always conduct your own research and review current company filings and market data before making investment decisions. So the next time you set out to value a stock, ask yourself, are you truly analyzing the business or just relying on a lazy label? Thanks for joining us.